Welcome. Financial markets, the dynamics in the current context. Banks, inflation, policies, crisis, technology. I'll try to balance them by geography and theme. I'll give you few of my experiences of late in the last 2 to 3 years. To date, if you look at the big picture, these dynamics, fear and hope, are constant. It keeps realigning the asset allocation. Let's look back 22, 23. After COVID disruptions and supply chain issues, inflation surged globally in 2022. The war in Ukraine sharply increased energy prices, gas or oil, and food commodity costs. Supply shocks, disruption in production, logistics, war impacts on commodity exporting regions, demand rebound, economies opening up after COVID restrictions, monetary stimulus, and easy money from central bank that had to be reversed. Central banks, Fed or ECB, raised rates aggressively. Moreover, the monetary policy makers have revised it accordingly. Real income squeezed, inflation expectation became unanchored in some regions. Financial markets saw volatility. Bonds dropped, equities are under pressure, risk premium widened. Why? We understand markets are very sensitive, not just to interest rate, but inflation expectation. When it comes to policy, tightening too late to increase risk of overshoot. Role of external shocks also matters. War, weather can dominate fundamentals. We learn out of Silicon Valley Bank and regional banks' failures. 2023. In March 23, Silicon Valley Bank, SVB as we say, failed after rapid outflow of deposits. Around the same time, Signature Bank also failed. First Republic Bank collapsed in May 23. Mismatch of assets versus liabilities, high holding of long term, low interest securities that lost value when rates rose, high proportion of uninsured deposits, making banks run more likely. Rising interest rates squeezed margins. Clients need clients needs cash. Clients needing cash withdrew deposits quickly. The consequence we saw: market confidence shaken, regional banks stocks fell, regulatory scrutiny increased globally. Regulators around the world had to intervene so depositors are protected, bailouts and acquisitions. Liquidity risk is as important than credit risk, sometimes more. Liquidity risk is very important. Banks' business model need to consider stress under rising rate regimes. Very stressful. You have to keep liquidity at stake and you have to keep additional liquidity for buffer. As an experienced banker, I can tell you importance of regulatory framework for resolution, deposit, insurance, and constant stress testing. You have to do whether you're money lender or investors. You have to understand. Similar story we had in Evergrande and Country Garden in China, property sector crisis. Like you had financial crisis also collapsed on account of property downturn. Evergrande, one of the world's most indebted property developer, could not meet debt obligation, delayed results, defaults. So heavy borrowing, overcapacity in real estate, declining demand in property sectors, government policies that limited leverage of developers, weakness in local government revenues. Default hurt bondholders and suppliers, ripple effect across financial institutions and markets with exposure. Investor sentiments towards assets weaken. So what we understand is leverage and regulatory risk are major threats. Market valuations can ignore embedded regulatory constraint until a crisis hits. Emerging markets are vulnerable both domestic mismanagement and global capital flow shifts. Take for example this year, US market crash. US government announced sweeping tariffs on many imported goods. Market reacted strongly. Global stock indices lost trillions of dollars. Sharp sell-off in equities increased volatility. The policy shock, unexpectedly trade restrictions increases cost of business, uncertainty about future trade flows, fear of global retaliation, higher input costs, inflation risk, and disrupted supply chains. Consequence, investors panic, risk of behavior, capital flight to safer assets. Currencies, bonds, commodities all felt the ripple effects. Possible losses for companies heavily importing, reliant on global supply chains. Lessons, policy decisions can trigger very large market responses if unexpected. Global markets are tightly interconnected. We have to understand this. Risk management must include plausible policy shocks. Now, we are also seeing the good side. Rises of ESG 2025 saw record issuance of catastrophe bonds as insurance transferred climate risk into capital markets. Investors are increasingly valuing environmental social governance aligned with investments. ESG funds showed resilience during recent turmoil in Europe because growing awareness of climate risk, increasing frequency, severity of extreme weather, demand by institutional investors for assets that align with sustainability goals. Regulatory encouragement and risk disclosure requirements in many jurisdictions. It's an opportunity. We have to understand. New asset class and risk sharing mechanism are expanding. ESG premium valuation affect firms with good ESG credentials. So lessons are important. Non-financial factors are becoming central to financial market risk assessment. Market innovation flows both regulation and investors. So that's the essence of it. We have to understand everything is an opportunity when there is a crisis. But if you overdone, if you clearly not understand the market dynamics, you will lose your committed capital. Let's be measuring the risk as well as opportunity. Let us create balanced flow with a committed responsibility to social risk management.